Portfolio Builder members, we are now 12 and a half months into our Trade Alert advisory, and we've delivered 16.67% and have experienced many different market conditions, from the Christmas crash last year to the May crash to the August crash, tariffs, de-escalating trade war, escalating trade war, bonds traveling in the same direction as stocks, a decoupling of that correlation, gold having a significant rally for half the year, then pulling back only to surge at year end. We've had to deal with a lot of different circumstances, and the result is a very low volatility return. If we do take a look at 2019 in general, we've had a maximum loss of 1% while generating a 14.93% return. Now, I do want to note that I have added in the dividends of the year for each ETF. Now, we did miss a couple dividends, but those were not added, and those were all accounted for in the month of December. Moving forward, I will add them in monthly. If we scroll down in the track record sheet, we can see our SPY return with 3 losing months of negative 1.2, negative 1.1, and negative 0.9. Other than that, gains of 3%, 2.6, 1.5, flat in April, 3.4% return in June, 0.9 in August, 1% in October, and then a little bit of a boost with the dividends for the entire year accounted for in December of 2.9. Total return in 2019 for the SPY with our strategy was 14.8%, and you had a grand total, if you add up all of the drawdowns for the entire year, a grand total of 3.2% drawdown, or a maximum drawdown in a 30-day period of 1.2%, and that's to deliver a 14.8% return. And remember, in December, the S&P 500 lost 16% last year. In May, it lost 7.5%, and in August, it also lost 7.5%. So by using options, we're actually able to profit in both directions when we get the feel for what's happening in the market correct. Our equity portfolio 2 returned 21%, but it did have a lot more drawdown. In the month of September, it lost 6.2%. So this is a very healthy year-to-date return, and still far less drawdown than you would have had simply owning the S&P 500. But remember, I'm willing to take more risk in this portfolio because it's only 10% of our total assets, whereas the SPY is 40%. Now, looking at the precious metals portfolio, I do want to point out that we did grow this from 2.5 to 5 to 10%. So the total return is around 35%. And the average return, or the sum of the total returns per month, is far higher, as you can see. So this portfolio, we take the maximum risk in our strategy, playing gold, silver, and then different types of cryptocurrencies, currently only Bitcoin and Ethereum. Now, Bitcoin was the top returning asset of 2019, although just about everything went up. We did very well with this portfolio from February through June, and then since July, have experienced some drawdown. However, this trend has begun to reverse as we have a 2.8% return in December, and all signals are looking great for gold and cryptocurrencies. Now, our bond portfolio had been rock solid until September of 2019, including a nice run-up in December, with the only losing month being February, when actually Powell began becoming very dovish, signaling that there were no more rate hikes, and shortly after he would begin cutting rates. We've had some drawdown in the last 3 months, although I do suspect, if our prediction is correct, which is yields will fly up into 2020 due to massive government deficits, no rate cuts, and less uncertainty with geopolitics between U.S. China. I think yields are going to scream higher. a lot of debt that's at a low or negative yielding yield is going to be in some serious trouble in the next 3 months. So we're currently betting aggressively down in the bond portfolio, and I think that'll turn out very profitable for us going into 2019. Now, risk disclaimer, of course, trading comes at great risk. We'll put the full disclaimer up at the end of the video. But that shows you your return per strategy. Again, if you look at any individual strategy, you have multiple losing months, a lot more volatility. If you combine all of these strategies together, that's when we get a super smooth return with only one losing month in the past 13 months. Now, we broke even in November, and we've had some months where we made less than 1%, some months where we've made more. But what's important is we're paying attention to the big risks in the market, and we're playing it safe. The last 6 months, if you thought there would be a trade resolution and you just bet big on stocks, you did very well. But had you been wrong, you could have been walking away with losses to the tune of 10 to 20% in a short 90-day period, just like we saw at the end of 2018. So my job is to help you protect your nest egg and make smart decisions to protect your capital, even if it means missing out on potential profits. So looking at our return in August, September, October, November, they were a little flat, especially if you compare it to the S&P 500. But I guarantee you they were split seconds away from escalating the trade war versus coming up with this phase one deal that doesn't really say a whole lot and really just gives China the good faith that they will do what we've asked them to do. So it really looks like this trade deal has been pushed to 2021 after the election. And that brings us to the next part of the presentation. We're going to review some of the most important charts and what our predictions are going into 2020. So there's a quite remarkable correlation to Fed balance sheet increasing, being very bullish for stocks and bearish for bonds. And rate cuts are typically done after stocks have crashed and become very bullish for bonds and seem to coincide with a negative period in stocks. So right now the Fed has indicated, and I think with the developments from China starting to actually pick up a lot of pork and soybean, that we're most likely, without some sort of massive fear in the markets, going to continue this correlation. We're in a period of QE. We already did the rate cuts. So rate cuts came in and boosted bond prices. Now the fear is gone and we're in a period of QE. So this is why we are currently long stocks and short the TLT. Now there could be a little bit of resistance from the TLT finding higher yields, reacting to the opposite feeling we had all of 2019, which is all the debt from Europe primarily, sending its money out of negative yielding debt bonds and into positive U.S. yielding bonds. So I think we're going to have a little bit of resistance getting yields to go higher and higher in U.S. Treasury markets. But the overwhelming force is going to drive capital out of the bond market into equity markets and eventually drive yields significantly higher. And that's where we expect the stock market rally to end. So where are we looking for? This simple little animation that I have on my screen really indicates what I believe could happen just like in 2018. And this is not for a long-term stock crash, because I do believe the Fed has a little ammunition. One more big round of bazooka ammunition, actually, that they'll roll out in 2021, coinciding with a new trade war. But let's just look at what happened. As you can see, in 2018, the bond yields significantly rose as we had quite a bullish stock market. Now, this was also being helped with the Fed raising interest rates and doing quantitative tightening. So there's certainly quite a powerful effect of those two on the bond market. But the minute the Treasury yield got above 3%, that's when stocks began to crash in the US. And this is while emerging market stocks had been crashing the entire year. So my fear for the US stock market is that at some point in 2020, the yields on the 7, 10, 20, and 30-year treasuries are going to slowly push higher and higher until they become so attractive that it does cause money to outflow from stocks into bonds, because the bankers know two things. One, a 3% guaranteed return per year is too attractive to turn down, so they will leverage into that with every penny they have. Two, they know that does cause stocks to sell off. And then three, what does the Fed do when stocks sell off? They cut interest rates. Now look at the blue line down here. This is what happened by current in December after the Fed cut rates throughout 2019. And this was right after we had the stock crash at the end of 2018 last year. So the bankers know, number one, they get a guaranteed profit. Two, they know that the effect of this causing stocks to crash will force the Fed to cut rates. This is where we go to 0% rates. And perhaps the Fed then follows up with quantitative easing in the middle and long end of the Treasury curve. So the bankers are going to be looking forward to the opportunity to buy debt at a high yield, have a guaranteed profit, and then sit back for a year or two until rates get super cheap and QE vacuums up these bonds out of their portfolio, not for 3% profit per year. And after you adjust for inflation, 1% a year, no, they're going to be able to flip these bonds for 20 to 30% profit to the Fed with no risk of these bonds making the prices go against them because they're unloading so much into the market. So if I'm correct, and we have less surprises from Trump going into 2020 because of the election, if China is having enough problems with food inflation that they just want to buy food and push this war until another day, if the European banks are going to do better than the ECB thinks, which perhaps they will, then we might have a benign 2020 where stocks slowly but surely rise, probably quicker in the first half of the year as money is getting out of bonds quickly into stocks, and as the yield gets higher and higher, that will slow down how fast stocks can appreciate. So I'm expecting a fast move in the first 2 quarters in 2020 for stocks to rip higher and then to slow down, and to see the exact opposite in treasuries. So we'll see that TLT fall quickly and then slow down as its yield becomes more and more attractive. And I think this is where we end up with the next crisis. So how long exactly it takes for yields to get somewhere around 3% is a good question. And so that's what I'll be paying most attention to, beyond making sure China is buying the proper amount of agricultural product to keep Trump happy from re-engaging in the trade war. So this is our disclaimer. A few last notes. Gold, I think, will have a decent year in 2020, but really what should make it go insane is when we go into real QE. Currently we're in fake QE because we're just buying short-term debt that'll have to be rolled over obviously every 1 month, 3 months, or a year. So they're having to roll over this current QE so quickly that they're not considering it long-term effects or distortions to the market. So I think this is bullish a little bit for gold, but really, as soon as the Fed is forced to cut rates to 0 and then go into full-blown QE shortly after, buying not the short-term debt, but the medium and long-term debt, that's when gold just goes bazooka. So that's what we're looking for in that part of our portfolio. Emerging markets should go up alongside the SPY. If it doesn't, that's going to be another warning sign that trouble is coming, and will make us think twice about being so negative on the bond market. So if we don't see emerging markets keeping up with the SPY, just like we didn't see it in 2018, that will be concern. But big difference, 2018 was QT and raising rates. This year is low rates, lowering rates for a lot of emerging market countries, and we have tons of QE. So those should go up together. Plus, we have no more problems between the US and China. So once again, if we don't see emerging markets going up with a SPY, that's a good alarm bell for us. If we don't see the Chinese purchasing agricultural products to the tune of at least a couple billion, $4 to $5 billion a month within 6 months, that could become a problem. We've got a few impeachment wild cards with John Bolton still yet to be heard from. So there's certainly still some risks. But with QE in full effect, I'm pretty bullish on stocks and think this should play out in our favor. So thank you guys so much for your time. Looking forward to daily webinars next week, except for Wednesday. The markets are closed, so our SPY trade will trade from Monday through Friday, and then we'll trade emerging markets Tuesday, and then GDX TLT on Thursday. Okay, thank you and have a great